Hello and welcome to the lecture for part 2 of chapter 21. Please note that there'll be 3 lectures for chapter 21. There's quite a bit of content in this chapter and I want to make sure that I don't overwhelm you with too much in any one lecture. So I'm going to split it up into 3 chunks. So this part of the chapter deals with the relationship between the costs that a company incurs, the volume of business that they are engaged in, and the profit that results from that. So factors that go into this are things like the selling price, how much product we sell, what our cost for making the product is, what all of our overhead costs would be, and then looking at what the profit that results from that. So the benefit of knowing this kind of a model is you can answer some questions like, what if we changed our selling prices? What would happen to our bottom line profit if that was the case? What if there's a change in cost? I know a lot of businesses that had to deal with this when minimum wage increased in Washington State, where their costs changed. So what's the impact of that? Businesses that had to say, well, if minimum wage goes up to $13.50 an hour, what is the impact going to be on my cost structure? And does that mean I need to raise my prices in order to still make money? That's a good example. Changes in volume. What would happen if our sales decreased by 20%? Or by 50%. If you're a restaurant owner right now and you're looking at in the next 2 or 3 weeks being able to reopen at 50% of capacity, you need to be able to know, are you going to make money at that level? So what's going to happen? You could use models like this to answer that question. And then a product mix. So we'll talk about that in the next lecture, but what mix of products am I selling? Not every product is going to give us the same kind of profit or have the same kind of cost structure. So the mix is going to have an impact on it. So an important concept here is contribution margin. So contribution margin is what's left over from taking sales and subtracting all of the variable cost. So those variable costs are going to include things like direct material and direct labor that would normally be in cost of goods sold. It's also going to include components of selling and administrative or overhead expenses that change with levels of sales. Some companies pay insurance based on their sales level. Some companies pay commissions to salespeople. That's a variable cost. The more you sell, the more you pay out in commissions. So we can make a little income statement based on the information we see here. Simple things like how many units did you sell? What's the price per unit? What is the variable cost per unit? So that one right there might include direct material, direct labor, and salesperson commissions. And then what are the fixed costs? Maybe the president's salary and the rent on the building and depreciation. I can make a little income statement based on that. So I can see sales of $1 million. I know I sold 50,000 units and the variable cost was $12 each. So my total variable cost must have been 600,000. When I take 600,000 away from $1 million, I'm left with 400,000 of contribution margin. The reason they use the word contribution is it's what's left over to contribute towards covering fixed cost and providing for income. So I can subtract my 300,000 of fixed cost and I can see that company had $1 million or $100,000 in net income. I want to just take a brief detour and show you something that I think is really useful. So here's an example of a company, and I have the same exact information. This is the same company, same results, but I'm showing you 2 different formats for an income statement. So on the left is a traditional income statement, which hopefully is familiar to all of you. So we have sales of $1 million, cost of goods sold of 400,000. That gives us a gross profit of 600,000. We subtract selling and administrative expenses of 400,000. So this company has net income of $200,000. Now that's perfectly fine, and that's an adequate way to present an income statement. But if you were running this company and you wanted to know, what if my sales fell to 800,000? What would happen to that bottom line net income? Would it go to 0? You couldn't really answer that question with that information. Now let's look at a different format for the same information. So I still have sales of $1 million, but now instead of subtracting cost of goods sold, I'm going to subtract all the variable expenses. And I've got variable manufacturing expenses of 300,000. That would be like direct material and direct labor. And then I've got variable selling and admin. Let's just say that's commissions. So I subtract 350,000, that gives me a contribution margin of 650,000. Then I subtract my fixed cost of fixed manufacturing costs, which might be depreciation on machinery and plant supervisors of $100,000, and I subtract fixed selling and admin expenses of $350 for $450. Notice that the costs are the same in both of these formats, and that gives me my net income of $200,000. So what this tells me is that I can look at the relationship between the contribution margin of the sales and see that 65% of my sales flow into my contribution margin. So if this company had an increase of sales of $200,000 or a decrease in sales of $200,000, I can say $200,000 times 0.65, my contribution margin would fall by $130,000 to what, 520, okay? And I still have those fixed costs of 450, so my net income would go from 200,000 to 70,000. So that question about what would happen if my sales went down by 200,000, I can answer that immediately with this format. I've used this format in a lot of companies that I've worked for, and I found it to be much more intuitive to people that don't have training in accounting than the traditional format. So just a suggestion for you. So the other thing, I can look at the contribution margin either as a ratio, which is what I see here. I just used that when I looked at that financial statement, and I divided contribution margin by sales to come up with a percentage. So that's what's going on here. So the contribution margin ratio is the contribution margin divided by sales. Those are dollars divided by dollars. And then I could apply that contribution margin to any change in sales dollars, positive or negative, and immediately know what the change to my bottom line is going to be. So this is a really useful thing to know and a really useful thing to track. You want this contribution margin ratio in your company to be increasing over time, to be improving. The other way I can look at this is look at it per unit. So a unit contribution margin is the selling price of each unit minus the variable cost for each unit. So in this example here, the selling price is $20, the variable cost is $12. That means that each unit that I sell gives me $8 that I can use towards covering my fixed cost and providing for a bottom line. So in that case, if I know the change in units, what if I get an order for 10,000 more units, in this case 15,000 more units, I can say 15,000 times 8, that'll add $120,000 to my bottom line. So that's a really useful thing to know. So that leads us to break-even point. So break-even point is the point in a company where they have sold enough so that their profit is zero. Their revenues and their expenses are the same. So revenues of $1 million, expenses of $1 million, net income of zero. That's breaking even, okay? So I can calculate that. A lot of times when companies are losing money, they might say, well, how much more would we have to sell to just get to zero, to just break even? That's a really common question in companies like that. So the break-even sales in units are the fixed costs of the company divided by the unit contribution margin. So as an example, well, I've got an example coming up next. I'll show you here. So this company has fixed costs of $90,000. Let's say that's the owner's salary and the rent, okay? And for each unit that I sell, I've got a $25 selling price, and I've got a $15 unit variable cost. Let's call that direct material, direct labor, and commission. That gives me $10 left over after every unit I sell to help me cover that $90,000 fixed cost and potentially provide for a profit. So for every unit I sell, I get a $10 bill left over. Think of it that way. So the break-even sales in units is how many $10 bills do I need to cover that $90,000 fixed cost. So I can take 90,000 divided by, in this example, $10, and that tells me that I need to sell 9,000 units. So when I sell 9,000 units, I break even, I have a profit of zero. I don't make money, I don't lose money. That's the goal, okay, if you want to think of it that way. So I could calculate it, and this is in units, I could also calculate it in sales dollars. So if I calculate it in sales dollars, I'm going to divide fixed costs by the contribution margin ratio, the percentage that we talked about. So this is a little bit less intuitive, but here I'm saying of my sales, what percentage, what volume of sales do I have to achieve so that the percentage of my contribution margin will cover my fixed cost, okay? So the first line there, contribution margin ratio, that's just a reminder of what we calculated a few slides ago. So now I can take the fixed cost of $90,000, divide by 40%, and I have sales of $225,000. If I divided the answer we got on the previous one of 9,000 units, if I multiply that by the $25 selling price, I get $225,000. So it's the same break-even point. It's just whether I express it in units or whether I express it in dollars. Now it's important to kind of keep track of how changes in costs are going to move this break-even point up or down, okay? So in this case here, if our fixed costs in the company, in this example, like it was the president's salary and the rent for the building, if the fixed cost goes up, that means our break-even point is going to go up. I have to sell even more units to earn enough, to get enough $10 bills in that example to cover my fixed costs. So I have to sell more. Fixed costs go down, I have to sell less to break even. If my unit variable cost goes up, that means there's not as much left over from each sale to cover my break-even point. So in that example where we had a $25 selling price and a $15 variable cost, if that variable cost went from 15 to 18, instead of having $10 from each unit, I would only have 7. So I've got to sell more units if each one is only giving me $7 to cover the same fixed cost. So my break-even point would go up. I'd have to sell more units. Same token, if it goes down, I can sell less units. So another thing to look at is target profit. So most companies don't have a goal of breaking even. They have a goal of making money. And this is really just an extension of a break-even formula. If you think of break-even as saying, I want to cover my fixed cost plus 0, plus no profit at all, then this is really just a slight modification of that. So I'm going to say fixed cost plus whatever it is I want to make, okay? Divided by my unit contribution margin will tell me how many units I need to sell to have that amount of profit. So in this example here, I have fixed cost of $200,000. I want to make $100,000. That's my target. I have a unit selling price of 75, variable cost of 45. So each unit I sell gives me $30 towards that, covering my fixed cost and earning $100,000 in profit. So I can have my numerator be fixed cost plus the target profit. I need to cover 200,000 plus 100,000, 300,000, and each unit I sell is going to give me $30. So how many do I need to sell? I need to sell 10,000 units. So if I sell 10,000 units and each one gives me a contribution margin of $30 each, I will have earned $300,000 in contribution margin, which will cover my $200,000 fixed cost and give me $100,000 in target profit. So here's another way to do it with the contribution margin ratio. And again, the only reason I'm going to use the ratio versus unit is if I want to end up with sales dollars versus sales units. So in this case here, you can see how the math works there. The same numerator, the same 300,000. In this case, I divide by 40%. I need to sell $750,000. If I multiply $750,000 times 40%, I get $300,000, which covers my $200,000 fixed cost and provides me with $100,000 for target profit. So I hope that makes sense to you. I will post a video practice for a problem like this tomorrow. And so that will help you with the homework that is going to be due on Wednesday. Thank you very much.